You are not going to get rich renting out your time. You must own equity, a piece of the business, to gain your financial freedom. Now, those are the wise words of Naval Ravikant, a notorious investor and entrepreneur from Silicon Valley. He used to be the CEO at AngelList, has invested in Uber, Twitter, Squarespace, and so many other startups that you've heard of, and has invested in over 200 companies. Now, early on in startups, shares are the most valuable currency for entrepreneurs because oftentimes they don't have hundreds of thousands of dollars to start paying out employees to attract awesome people to their startup. And learning how to use these shares or this equity in your company to hire the best people is a skill that entrepreneurs absolutely have to master to be able to increase their chances of success. So who should you be giving equity to and why? How much equity should you be giving these individuals? What are some industry benchmarks that we can base ourselves off of? And what are some mechanics that you have to understand before you walk into a room with an investor? What's up everyone? Welcome to my channel. Christian Peverelli here, co-founder of We Are No Code. Now in this channel, we teach tricks and tips for non-technical entrepreneurs to build their businesses. And we also go behind the movement by interviewing investors, startup entrepreneurs, and showcase some of their success stories so that you don't have to make the same mistakes. So again, follow, subscribe, turn on the notifications. Let's go, guys. Okay, so if you're like most entrepreneurs kicking things off and you don't have hundreds of millions of dollars in a trust fund somewhere that you have access to, or maybe a rich Uncle Job, then you probably want to learn about how you can leverage equity to reduce the amount you pay employees, to attract awesome investors, to attract amazing advisors, and we're going to break down a couple of things. Now, the first thing I want to talk about is this huge difference between being paid a salary and being paid shares. Now, as an early stage founder, you hold a lot of the time and money investment into your startup. So it's natural that you would hold a huge amount of the shares as well. Now, shares, as we all know, are really representative of how successful the company is. So since the risk is really high in starting out a business, you can expect to get higher rewards if you're able to grow it and to sell it, or to grow it and take money out of the company through dividends or other mechanisms. As an employee, it's completely different, right? As an employee, you have very low risk. You're being paid a salary every single month, but you probably don't have as big of an upside, or let's say of a reward, if you are successful in what you do. So basically, as an owner or someone who holds equity, that equity is high risk, but it's also very high reward if it is successful. Whereas as an employee, you take low risk, but you get low reward, or at least you're very capped in terms of the reward that you can receive. Awesome, now that's covered, let's jump into who you should actually be giving equity to. Now, the first and most important segment here is co-founders. So a co-founder is someone who's going to accompany you very early stage in the process and will receive a substantial amount of shares. So if we look at kind of the classic way you would imagine a company starting, two friends in a garage, and they essentially get together and say, hey, let's build out this company, you would probably see a split, which is 50-50, unless some person has invented some crazy thing and is bringing a huge amount to the table before the other person joins. Now, in general, co-founders, since they're taking on a big risk as well, they're going to be receiving the most amount of shares usually, compared to later stage hires who are there to grow out an existing business that already works. Now again, early stage in the company, it's very risky. Later on, as the company grows, it's much less risky. And so giving out shares doesn't make as much sense later on in the company. Now let's be very clear, co-founders are the people who are going to be there in thick or thin. So these are long-term players taking a big risk and wanting that kind of reward as well. And they're individuals who are going to actually build out the company with you full-time every single day. Now, if an individual is not willing to go full-time, that might be a red flag that it might not be a good co-founder for the company. Now, the second type of people you want to give shares to are employees. Why? Because you actually want to retain them in the company. Give them an incentive to stay longer in the company because they know there will be a large exit, or they know there's going to be some kind of a liquidity event that even with a small number of shares can essentially give them a lot of return. Now, employees will have way fewer shares, but we are going to use some of those shares to counter their salary because we won't be able to pay them their market value, but we are willing to give them some compensation in shares accompanied with a smaller salary. Then there are investors. These are individuals who essentially want to multiply their money. They're taking money from people and they're investing in companies to multiply that money for them. they take a commission for managing the money, and they also take some earnings if it is successful. Now, it's pretty obvious why you want to give these people shares. They will be giving you a check. They'll be giving you money, which will allow you to grow out your business. Then we have another section, advisors. These are individuals who will not be quitting their full-time job to join your mission, but are very aligned with what you're doing and have potentially a large Rolodex of individuals they can introduce you to, or deep knowledge within the field that you're working with. Now, these individuals are willing to show up once a month maybe for a meeting, and they might be willing to hop on calls when you need them and make some introductions, but you should also understand that those people are not going to be the ones building your business firsthand. Now, those are basically all the individuals who you should be willing to give shares to. Now, there are also people who you should really watch out and potentially not give shares to. Now, one category who you should probably not be giving shares to are contractors. If these individuals have a short-term role in your company, it's most likely not going to be a good fit to give them shares in the company. A great analogy I love here is, would you give the contractor, or would you give the architect, or would you give the bricklayer 30% of your house? The answer is probably no, and it's for very similar reasons. When people have a short-term role to fulfill in the long-term vision that your company is, then you most likely will want to just compensate them for their work and not give them a chunk of your company. Okay, so the next classic question we get all the time is, how much equity should I give to these individuals? Now this, like many answers in life, is it depends. Now, I know people really hate this answer, but let me explain a couple of the factors that will really influence how much you are giving people. Now, the first thing to understand here is that timing trumps seniority. What do I mean by this? Well, in the same way that an early stage co-founder would get a large number of shares, the later you join a startup along its journey, the lower the risk and the lower the reward you can expect. So one of the factors is the role in the company. So if someone is going to be the CTO of a company, they will be probably making more shares than someone who comes in at the same time and is potentially just an engineer. And the third factor is opportunity cost, right? An individual who comes in with a huge amount of experience, who is making $300,000 at Google, we have to take that into consideration when we actually are proposing to them a structured deal, which is a mix between some salary and then some shares. And that's why you really have to make these decisions on an individual level. So each case will be very different, and you need to figure out, how much do I currently value the company at, and what proportion of those shares would represent that opportunity cost that that person is giving up. So there are some mathematical ways that you can go about calculating this, but a more important thing is for the individual you're talking to understand the logic behind why you're giving X amount of shares versus Y amount of shares.
But Christian, just answer my question. How many shares should I give out?
Okay, let me give you my personal benchmark based on the deals that I was involved in, and also the deals that I saw flow through the accelerator program and have seen investors invest in. A co-founder, I would say, usually receives anywhere from 50% if they're really early on and they jump in full time, all the way down to about 5%. And of course, if the company is generating revenue, then that person might not even be called a co-founder. It really just depends on the situation. Investors usually, when they come in and invest in your company, they're going to be taking between 15 and probably 30% of the company on each round, depending on the size of the round again. Now with employees, it really kind of ranges based on when those employees join the company. It could be anything from the first hired person after the founders. Those individuals might make up to about 5%. But if we're talking about maybe the 10th person, we're already talking less than 1% of the company. And an advisor usually makes between 0.2% of a company and maybe 1% of a company. Now let's check out a couple of benchmarks in the industry. Courier, who is a serial entrepreneur turned venture capitalist, says on average he gives between 0.1% of a company and 0.2% of a company for an advisor. The way he talks about it is pretty funny too. You're basically surrounding yourself by intelligent people, giving them on average 0.2% of the company. Most of those people will not really help out, but if you get 5, you increase the likelihood that one person will say or introduce you to someone that will make a huge difference in your company. That's the way he really sees advisors in early stage companies. Another example is Anu Shukla, the founder of Rewards Pay, who hired a VP of engineering and paid him 3% equity. along with a salary as well. And their role was going to be to run the technical department. So really filling in kind of like a CTO. Now, another great example comes from Index Ventures, which is a venture capital fund in Silicon Valley. They have an awesome handbook where they essentially say that post-funding at a very early stage, they would give a head of engineering 1% of a company, for example. Another example is Silicon Valley Bank in an article wrote that for someone who would be hired as, let's say, the first hire, they would pay that person around 10% of a company. So it can really range. And so that's why it's important for you to understand some of the mechanisms behind this as well. If you're seeing a lot of value from this video, please smash that subscribe button. It helps me continue to do what I do and continue to bring awesome tips to you. Now I want to break down some of the important mechanics to understand when you are giving people equity or shares in your company. The first concept you want to understand is vesting. Now, when you join a company, their real incentive in giving you shares is for you to stay for the long run. So if they were to just give you shares, then you could just leave and keep all those shares and find a job that pays you better somewhere else. And that's why we have vesting. Now, a vesting schedule is essentially a period upon which you will be earning the shares that are promised to you. So let's say that you are going to have 2% of the company. Now that equals to, let's say, 100 shares, for example. Now those 100 shares would usually be on a vesting schedule. Now a vesting schedule can be usually around 4 years if we're looking at classic terms in venture capital world. And that means that out of those 100 shares, again, that's just an example, you would essentially earn 25 shares every year, which means that if you leave after 1 year, you would lose 75% of your shares. And so this mechanism is really just about protecting the company from people coming and going. Now, more likely than not, these vesting schedules also have what we call a cliff, which means that potentially if you have a 1-year cliff, it means that if you leave within that first 1 year, you won't earn any of those shares. So the first year can be the cliff, and after that you make 25, 25, 25, which means that you would earn those 25% over the first year, but if you left within that period, you would be sacrificing that. So you could consider the cliff kind of like a trial period where you're earning shares, but you won't actually get them unless you stay past that cliff. Now, another mechanism you really want to understand walking into the conversations with employees or investors is this idea of funding. Now, when you raise money, which is what funding is, you're essentially printing more shares, right? So let's say you have 100 shares in the company, you print 20 more, suddenly you have 120 shares in the company, which means that the people who had shares to begin with, let's say you had 20 shares out of the 100 shares, once you now have 120 shares, you actually have fewer shares in terms of percentage, but you have fewer shares of a larger pie. And this is what we call dilution, when the percentage of the company that you own is smaller, but of course the value is higher because the company value is higher as well. So an example I gave, essentially, if you had 20 shares out of the 100 shares, and then you issued or created an additional 20 shares for, let's say, investors who came in, then you would suddenly have 120. You would have 20 shares out of 120, which is 16.6%. Yeah, I think that's correct. Versus the 20% that you had originally. However, keep in mind that money has come in the company and that usually that money has been accepted at a higher valuation or higher value to the company than when you got those shares originally. So it's a completely normal mechanism that happens every single day in startup world. That being said, if someone does not understand these mechanisms, they might really feel upset if you promise them 2% of the company and then it becomes 1.6% of the company. And the reason that's an important concept is because if you're bringing on investors who have no idea about the tech scene, you're gonna kind of have to explain to them some of these mechanisms. If you're bringing on employees who are only from the corporate world and are used to getting their usual pay, they also won't understand these mechanisms. So usually it's just to make sure that everyone's on the same page. Now, another concept you want to understand is option pools. Now, option pools are essentially a set of shares that are going to be dedicated for future employees and are going to be dedicated to future advisors and people who you need to give shares to as you grow out the company. So usually when you're negotiating a deal, you also keep an amount of shares open so that you can distribute that to future hires. Now, I'm not going to go too deep into explaining these pools, and I'm definitely not going to talk about single triggers or double triggers or clawbacks. But if you want to learn more about that, I highly recommend a book called Venture Deals. It was written by Brad Feld and Jason Mendelson, and you can find it on Amazon. I think it costs like $15 or something. Really valuable stuff. These guys have kind of seen both sides of the table, and they give great advice. And it's just a great way to understand kind of the mentality behind fundraising, behind going through these venture deals, specifically in venture capital, which again is a different kind of investor than an angel investor or friends and family. So I hope you've learned a lot through this video and that you understand the basics around how you should be thinking about distributing shares in your company. Again, if you want to get out of the rat race, you need to stop selling your time for money. And that's why a lot of people are starting businesses or joining existing businesses as co-founders. But if you're looking for a co-founder and you're very, very early in your startup, I would highly recommend not to get lost and try to negotiate in small percentages. There's actually one quote I love. 1% of $1 billion company is 10 times more than 100% of $1 million company. And so my point is, don't try to nickel and dime people very early on. But in parallel to that, be very careful in the way as you grow out the company that you distribute equity, because it reflects directly on your ability to negotiate with different individuals. Subscribe to the channel, check out these 2 videos, and see you in the next episode. Take care, bye.